estate planning to effective administration, helping you to better understand how to ensure a legacy is not only planned for, but seamlessly executed. It is my honor and pleasure to introduce our moderator for today, Sarah Nkwana, who is the Head of Estate Services at ABSA Trust. Sarah brings with her more than 18 years of experience in the financial services sector, with expertise that span banking, insurance, and fiduciary services. She holds multiple qualifications in banking, wealth management, insurance, strategic leadership, and learning and development. In addition to her corporate roles, Sarah is an accomplished entrepreneur and a registered industrial and organizational psychologist. She is currently pursuing her PhD and serves as the president of the Top CEMS Club, a society for UNISA's top 100 performers. Just in terms of housekeeping, I ask that you pop all your questions into the chat so that the panel can answer them at the end of their session. With Sarah guiding the conversation, we're in excellent hands for an insightful and thought-provoking session. Thank you so much, Sarah. I now hand over to you.
Great. Thank you so much, Verity. Very a pleasure to be back here again on this platform with you and the rest of the people, and a very warm welcome to everyone joining us today. Always a great pleasure to see people wanting to learn and wanting to know more. And today really is about exploring how planning today makes a difference tomorrow when it comes to estate administration. What I normally find is people that I think since last year, I'm seeing a lot of webinars coming up in terms of estate planning and estate administration. And really, we want to get into what is the difference between the two, estate planning and estate administration, and what does the one have on the other. Before we do that, I want to first introduce our panelists. A great team of our panelists, starting with Yashvir Maharaj. Yashvir is a dedicated financial planner with over 11 years experience in providing holistic financial advice, product knowledge, and tailored solution to help clients build and protect their wealth while managing risk effectively. He holds a BCom in accounting and honors in internal auditing, a higher certificate in financial planning, an advanced certificate in leadership, and master's in business administration. Yashvir is qualified 4 times for a prestigious performance incentive tour, regularly mentors new advisors and supports leadership responsibilities by shadowing the regional manager when needed. Yashvir is also passionate about working with people, finding fulfillment in helping clients turn their dreams into a reality while enjoying diversity of personalities he engages with daily. Wow, Yashvir, I think for me that was a mouthful. I think when I went through your academic record, I thought it's not going to stop, but very impressive. And then our next panelist is Mornay. Mornay is an experienced estate manager with over 20 years in fiduciary field, including 9 years in leadership role. He oversees a team responsible for administering deceased estates, ensuring compliance, resolving complex matters, and delivering excellent client service. He holds a diploma in estates and an advanced certificate in financial planning, and is recognized for being self-motivated, taking pride in his work, and maintaining a patient, composed demeanor, essential qualities for his role. Outside of work, Mornay finds peace in the ocean, describing it as a source of calm and clarity. Mornay, I'm just with you there with the ocean. I think we are in the same WhatsApp group. I wish I could have that daily. But moving to our last panelist, we've got Melisha. Melisha is an admitted attorney, has over 18 years of post-qualification experience, including 13 years in estates and fiduciary services, and has served as an estate manager for the past 4 years. She leads a team of estate administrators and assistants focusing on efficient, client-centered, and estate administration and complex estate matters. Her achievement includes strong relationship with stakeholders to enhance fiduciary services and conducting postgraduate research on integrating AI tools into the industry. Driven by a passion for empowering others through knowledge, Melisha currently is pursuing a postgraduate diploma in business administration to blend legal expertise with strategic leadership. I think after reading all of that, I'm very satisfied that we've got the right people who can speak to us about this topic, not only from a qualifications perspective, but also from an experience perspective. They really hold wealth of knowledge. So to start off, and I have said this before, something that has been on my mind is really starting with the end in mind. When we do planning, but are we thinking about the eventuality of death? Are we thinking, what does our planning today look like? And I want to start off with estate planning. And to do that, Yashvir, I'll start with you. Can you start by outlining to us what estate planning really entails and why it matters?
Thank you, Sarah. Thank you, ma'am, for this opportunity. Good morning to you. Good morning to the panelists and to all those joined and logged in virtually. So I'm Yashvir, as Sarah did introduce me. I'm with the APSA Group, and let's talk about estate planning a little bit. So in terms of the estate planning, we look at financial planning as a holistic view, starting off with the estate planning. There's various legs within the financial planning industry. So one of them is estate planning. We do have the risk planning and the investment planning as well. So if we're looking at holistic financial planning, one needs to then engage with a financial planning expert to discuss their financial needs analysis, to have that drawn up for themselves. And the whole point of that is to, preserve, create, or mitigate risk. So you preserve your wealth, create wealth, or mitigate risk, any of the. And if we look at the first leg of financial planning in terms of the starting point of financial planning, we look at the estate planning. So essentially, estate planning is firstly starting off with looking at a liquidity calculator or liquidity analysis. Now, what that entails is looking at the client's assets and liabilities and ascertaining whether we have an executable estate in terms of whether there is a shortfall in the estate, meaning the assets are less than liabilities, or if we have a shortfall, a surplus where the assets are more than the liability. So when we look at the liquidity analysis, we put in all things in terms of assets that the clients might have that are executable. For example, the client's houses, properties, vehicles, cash without beneficiaries. And then we also look at the deductions within the estate, which is like aspects like your executive fees, your administration charges, your master's fees, and your property transfer fees. And at the end, we calculate whether there is a shortfall or a surplus. Now, why this is important is that if, for example, there is a shortfall within the estate, we as financial planners or financial advisors will then look at various vehicles in terms of putting together a plan to bridge the gap or bridge the deficit that is within the financial analysis or the liquidity analysis, such as life cover or state provider plans that will inject cash injections within the estate. So should one pass on, there is sufficient liquidity within the estate to execute that estate. Often one needs to be aware that should there be an unexecutable estate or an estate that has a deficit or a shortfall, this could lead to time, being wasted in the estate administration, whereby the family will then have to fork out cash. For example, the beneficiaries will have to pay the deficit in, or it could even result in assets being sold if there's a deficit within the estate. So it's very crucial from our point of view to do the proper analysis in terms of financial planning and make sure that there's no gaps. And if there are any gaps in the estate, try to cover it with vehicles that we have in place. What's also very important is that an annual review needs to be done at all times within, the client's portfolio, just to make sure that the financial position of the client remains liquid, and that we either increase cover wherever there's a shortfall, or maintain as well. So yeah, that basically covers in a nutshell the estate planning process. Sarah, back to you.
Thank you, Yashpreet, for that. And I think for me, that's critical. What we see here is that this happens during the lifetime of a client. And we haven't gotten into a lot of details, but high level, you've indicated what estate planning entails and why it's important and what impact it has. And we'll get further into the details later on. But I just want to now check. We've spoken about estate planning. Now somebody passes on and the focus shift. Can I ask to unmute, please? Thank you. Thank you. Apologies for that, colleagues. So once somebody passes on, there's clearly a shift in focus here from planning to administration. Now I'm curious about who steps in and what changes. What role do they play, and so on. And Melisha, maybe before I give over to Yashvir as well to add on, can I just give over to you just to show us the transition from planning where it's now during a life of the individual, but now they are deceased. What then? What happens?
Yes, so thank you, Sarah, and also good morning to our audience. And we're looking forward to quite an engaging session with you all. Thanks, Yashvir. You've definitely highlighted how much thought goes into building a solid estate plan and one that's going to see to the needs of the deceased, on their passing. Now, Sarah, once a person passes away, the focus really shifts from a plan to now putting that plan into action, to executing the plan. And that's why we say estate administration begins at the end of planning. So when a person passes away, the first thing that needs to be done is that the estate must be reported to the master of the High Court. And the master would then appoint an executor, either in terms of a will, or if there's no will, then an executor is appointed in terms of the Intestate Succession Act. And in some scenarios, an executor is appointed in terms of a bond of security. So once an executor is appointed, they essentially step into the shoes of the deceased. And their role is then to attend to all of the legislative requirements that's required in terms of the various acts that are governing deceased estate administration. They would need to collect the assets of the deceased, settle any liabilities, and then at the end of the process, distribute the remainder of the estate to the beneficiaries, either in terms of the will or in terms of intestate succession. Now, Sarah, practically, this is where we see family members starting to feel the real impact of planning decisions or the lack thereof. So I'll give you an example. Yashvir did mention that in estate planning, they look at various vehicles to bring liquidity into a deceased estate. And one of the main issues that we find when we are administering estates is the issue of insufficient liquidity. In our field of work, we call this a cash shortfall estate. And in those scenarios, the executors may be required to sell assets, actually forced to sell assets, if the heirs cannot find means to contribute cash into the estate to settle that cash shortfall. Now, I would say while planning is more a theoretical situation, where in a sense we're planning for the eventuality of death, administration is the very real process now of executing that plan, or if there's no plan, for the executor to make means to sort out the issues that might rear its head during the administration process. And there's also that added component of now dealing with a grieving family, family members that are coping not only with the loss of their loved one, but also requiring clarity. They don't know the process. They have a lot of questions. And, generally they're looking for quick resolutions. But this quick resolution can only truly follow smoothly if proper planning was done at the outset. Sarah?
Thank you for that. And I mean, it sounds like we have family executors, advisors, all significantly playing different roles. And if you could just maybe between you and Yashvir share some examples of how decisions made during planning directly shape what happens in administration. I know you've mentioned one, Yashvir, regarding liquidity. But what are some of these examples? And I think for me, it shapes it nicely. It starts with the, 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 the the individual in their life stages where they do their planning. They play a critical role and they engage with the financial planner or financial advisor. In that instance, it's important that you have a good financial planner and that helps you out. Your executor and family, the roles that they play. What are some of the examples, Melisha? Maybe we can start with you before we close off with Yashvir on this one. So just taking us through how the planning directly shape what happens in administration.
Sarah, so I'll just use the example of a family business. And we see this very often where you might have a person who has started their business from scratch. They've developed it with their family and it's a family run business. But generally, what we find is in those scenarios, those businesses don't have the documents uh, that determine succession planning and business continuity on the death of the proprietor, of the death of the person who started the business. And when it comes to the estate administration and the executor now, stepping into the shoes, as I said, of the deceased, if there was no documents dictating how the business aspect must be dealt with after death, or who is to take over the business, um, you know, by way of succession of the business and for business continuity, then the executor is sometimes forced to make certain decisions that might not be in line with the usual business practice, the way in which the family might have run things, with the deceased being alive at the time. So sometimes it tends to now topple the apple cart, as it were, because the executor is forced to only do things according to what the law dictates. So, in a business situation, it would be according to what the Companies Act or the regulations in terms of running a particular business may be. The family might have done things differently. They might have had a different way of maybe procuring services or paying for creditors or, paying salaries, for example. And that we found in practice can cause a problem and sometimes also a little bit of dispute between the executor and the family because the known way of doing things may not be how it can continue. And therefore, in the planning process, if somebody has a business, for example, that should have been one of the considerations to make sure not only is there liquidity, but also do you have your documents in place for succession planning? How is the business going to continue if you, Mr. Proprietor, are no longer around?
Yeah. No, thanks for that. Yashvir, I'm not sure if there's anything else you want to add there before we move on. And I mean, that's a big one in terms of business continuity as well. But over to you, Yashvir.
Thank you, Sarah.
Yashvir?
Just to add on to what Melisha has said, if we look at the drafting of the will, when one drafts a will, it's a very personal, request that the client is actually making should one pass on, because that's the only piece of legal information that is left in terms of how the client wants their legacy to be distributed. So if we look at a client, for example, that doesn't have a will, then it follows the interstate succession planning where, the assets might not be distributed according to how the client might require or want it to be distributed. So, that is why the will is something very personal and very, very important, and has to be updated at all times to keep the instruction as relevant as possible. The other thing is, if one doesn't have a liquidity within the estate and there's a shortfall, the time that it might take to source, cash injections from the family or source ways in which probably, worst case scenario, assets might be having to be sold, might take a long time. So what could take, a minimal time if everything is in place and there's a liquidity injection and there's proper, vehicles in place, could take a much longer time as well. The other thing that might be a bit personal there is where clients would, if they have minor children, could indicate that, they'd like guardians to be placed onto the wills. For example, one might say, should the biological mom or dad not be there, they might, have a brother or a sister or a parent that could step in to look after the minor child's needs up until the age of 18 years, where they're seen as being adults. The other thing is, a trust fund might also be important to put into the will, should beneficiaries be minors below the age of 18 years, because it makes it also, something whereby, if in the case there is no trust fund in there, we're looking at the estate being handed over to the government guardian fund, and that's also a big process that has to be followed to get the funds out of there. Yeah, so I think that's for me is the important touch
Yeah.
points there. Back to you.
No. And that's critical, colleagues. Again, one of the things that you touched on that's critical for me, we get a lot of complaints where people are saying it takes too long to administer. And what we're seeing here is that most of those delays, if planning is not done properly, if there's no proper paperwork done, discussions held, and I'm sure we're going to speak about that later, that prolongs the estate administration process. But I just want to delve deeper then, Melisha, into, if planning is not done properly. And I think Yashvir touched on that a little bit. Talk to me about when there is no valid will, and people need to understand, what do we mean by no valid will? Can you just take us through that? Somebody passes on, the will is there, but it's not valid. Take us through that.
Yes, Sarah. So for a will to be valid, it needs to comply with the Wills Act. And there are certain requirements that must be met for that will to be then accepted by the master as being a valid will. So in a scenario where there is no valid will, or if the person did not have a will to start off, then the estate will have to be administered in terms of the Intestate Succession Act. And this means then that the assets are strictly distributed according to the Act. There is no possibility of deviation. And, it may well relate to having individuals inherit where the deceased may not have wanted them to inherit. So, in practice, we also find that this takes longer for an executor to be appointed where it's an interstate estate, because there's no nominated or pre nominated executor, rather, in terms of the will. And the individual that is now taking up the appointment as executor may be required to submit a whole host of documents. And these would depend on the individual. So I'll give you an example, Sarah, where a person passes away and where one of their children is taking up the appointment as executor. Now, what would need to happen is their siblings would need to nominate him or her as the executor, and that's done by a nomination form that's a form specifically prepared by the Master of the High Court. And if one of the siblings perhaps has now subsequently passed on, then there's the added requirements for that deceased sibling, which would include a next of kin affidavit for themselves, as well as their next of kin submitting nominations for the executor now of the first dying. So you see, it can be quite challenging because there's all of these additional documents that are required. And more so, it can be challenging in the current day that we live in. I mean, there's many people that do not have that relationship with extended family members where it's just easy to get that nomination signed in favor of a particular person. There's also power dynamics in certain cultures. There are requirements for the eldest in the family to dictate what happens in the estate, and there may be that issue that we have to deal with. And this as simple as people now residing in different provinces and more often nowadays in different countries. So even just coordinating the signatures between the individuals can sometimes take months because the master requires an original nomination to be lodged with them. So you can see that just these practical issues can cause a delay in getting that aspect resolved. And once you've got the issue of the executor being resolved and the executor appointed, you then have to deal with the complexities that flow from the specific assets in the estate. So if we look at an estate perhaps where a deceased passed on, he did not have a will, or he had an invalid will, and it's now an interstate position, and the deceased has 3 children and a property in the estate. The Interstate Succession Act will dictate to us that all children must inherit equally from the estate. And if they married in community of property, then there's the added angle of their spouses now inheriting as well. But what if only one child resides on the property and has taken care of the property and therefore wants to keep the property, whereas the others are now living, in different places, they have their own properties, and they may rather require the funds and want the property sold. So we've seen that that in itself can create so much of conflict and delays, and sometimes it even resorts to litigation. And in the absence of a will, the winding up can definitely tend to divide families rather than keeping that unity that's required in this really grieving and essential time where unity is rather required between the people. Sarah?
Yeah. Thanks, Melisha, for that. And I saw some questions popping in. If I can just ask Yashvir, there's a text one, but we'll address that towards the end. If we could just look into that. Just delving deeper into these examples, Morne, I'm going to jump over to you. Are you able to can you also give us, in terms of the type of delays and risks families can face? And I did see now there was a situation where it's, or rather a question where they asked, what if siblings don't agree? But Morne, can you give us a practical example where a will leave, you leave a house for two siblings, but it's silent on who pays the bond. So just give us an example there or a scenario just to show us further complications that causes the risks and the delays in this instance.
Morning, Sarah. Yes, thank you. And I'm looking forward to share my knowledge and experience with the audience. If we look at the scenario now given by you, for example, where the deceased left his house to two siblings, but silent in who pays the bond. Now, normally the bond will be covered by the estate. So if there's money in the estate will have to pay for the bond to settle it. But if there's no money in the estate, say, for example, the bond is outstanding 300,000. Now, both siblings, say sister and brothers, inheriting equal share, then we will go to them and say they have to apply for that bond to take it over, or they have to settle it. Now, if they have no means to settle it and they do not qualify for the bond, then as executors, we'll have to ask them if they are prepared to sell the property, because there's no other method or left for us to now distribute that asset to the heirs. So that is a common problem that we sit lately with, where maybe the brother will qualify to take over the bond, but the sister doesn't qualify. Then we must maybe ask one of them, do they would like to sell the other half share to the brother so that he can take full ownership of the property, and in return, the sister will get cash. So there's various options to give to the clients, but it is a delaying the estate in the end of the day. Just going to give another scenario quickly that we also experience if there was no proper planning made. Let's look at a joint will where the deceased was married in community of property. Now, in the clause of the will, it will say, for example, first dying bequeath his or her estate, which include his or her 50% of the marriage in community of property as followed: the farm as no water, as well as the remaining fixed property to our son William, subject to the usufruct in favor of the surviving spouse, and then the residue to the surviving spouse. Now, clause 2 of the will says, in the event of the death of the survivor, the farm known as no water, as well as the remaining fixed property and removable farming assets to our son William. Now, if we look at this scenario, marrying community of property, a joint will, the clear intention of the testator and testatrix, that's the husband and the wife, at the time of drafting of the will was that the wife, the surviving spouse, must get a usufruct. A usufruct is where that person, the son, William, will get the farm, but the surviving spouse will get the usufruct where they can stay on that farm, enjoy the farm. All they have to do is pay the municipal account, upkeep, maintain it as in the way they got it. But on their death, only then the farm is actually the son's, William. Now, it is clear here we have a problem. We cannot subdivide a farm. Now, if proper planning was made, this would have been realized and informed the client, but you're marrying community of property, your wife or you own half, so if you die, we can't transfer to your son. Normally, we would make a subdivision clause in the will to say that if a farm cannot be subdivided due to the Subdivision of Agricultural Land Act, then such property can then be put into a trust or a PTY, or Nowadays, you can't do a CC anymore. So if that option was given in the will, we could have gone that route. But unfortunately, in this example, there was no subdivision clause. So now the wife, the husband passed away in the scenario. The wife didn't want to give up her portion. So at the end of the day, they had to go and create a trust for where William and the wife had an interest in the trust. We had to sell the farm to the trust, which caused a big delay in the estate due to the trust that had to be created. And in the end of the day, the other brother, the son of the deceased, also got involved and I was also involved with the trust. And in the end, was that really what the testator or testatrix wanted when they drafted the will? So clear, if a proper planning was made at the beginning, all this could have been avoided. William could have gotten the farm if a subdivision clause was included into the will, or if explaining was done to the two when they drafted their will to say, but you cannot give it to your son because the surviving person will still have an interest. Yes, we can see the intention was the usufruct, but there was flaws in the estate planning. Thank you, Sarah.
Thank you so much, Morne. We can see that, even though your examples and even Melisha's examples, we're able to see that even though planning has occurred, it doesn't always work out the way it should. And I just want us to explore that even further. And Morne, I just want to come back to you as well. So where do you most often see wills and estate plans breaking down in practice?
Sarah, basically it is poor drafted wills, looking at ambiguity, missing errors, or impractical instructions. Let's look at the basic rule is that when a well-drafted will should be clear to a person who is able to understand a will. So it should not be ambiguous. Is happening where the people drafting the will is saying one thing, but when in reality they're saying more than one thing. So it must be clear what the testator or the testatrix, the husband or the wife, their intention was, and avoid misinterpretation. So avoid long sentences with too many clauses. Sentences should be short as it's compatible with clarity. Another problem with poorly drafted wills will be try to give as much possible of the details of the heirs. Now it's easy. I bequeath my estate to my children, Jan and Sunny, but give their full names or their ID numbers, which will help the executor. If, for example, you nominate a friend, I bequeath 200,000 to my friend Pitt. Who is Pitt? Does the family know Pitt? Give Pitt's last known address and his ID number. Or say in the will, bequeath to Pitt, Joe So knows Pitt, and then the executor will then know who to contact to establish who this Pitt person is. So that is another example. And for example, your organizations, you bequeath to an animal welfare organization XYZ, 100,000. Was the intention for the XYZ Animal Welfare National Office to inherit the money? Or was it for the office in Uitenhage, for example, to get the money? So the draftsman that's drafting the will while seeing the client must get clarity when drafting the will from the person. Thank you, Sarah.
Thank you so much, Morne, for that. Melisha, from your side, from an administrator side, what are the most common red flags, things that create unnecessary conflict or delays?
Yes, so Sarah, both Morne and Yashvir picked on the big one, which is the liquidity issue. And that's a red flag that comes up again and again. More so in today's economy, people are not really ensuring that they are taking out those products to ensure that on their passing there is liquidity. It's just not seen as important for most people now. But you know, the impact of that is we find estates that can have a lot of valuable assets like property, like furniture or shares, assets that are not liquid. And with no liquid cash readily available to settle the liabilities or the debts in the estate, even funeral costs sometimes, it may force the executor to make the hard decision and sell assets. And this can go against the family's wishes because in some circumstances they might want to retain those assets because of sentimental reasons or personal reasons. I had a particular estate where a family farm that was passed on between generations was actually required to be sold simply because there was not enough cash in the estate to cover the estate duty that was now part of the debts in the estate. And estate duty is a debt that's paid to SARS, and there's no way around the payment of estate duty if estate duty is applicable. Now, proper planning could ensure that you have means to avoid a state duty being payable. But if there is a state duty that becomes a payable, then the executor needs to make means to settle that debt in particular. I also touched earlier on the issue of businesses. So again, I want to stress that family-owned businesses need to have proper continuity and succession planning. And that's also something that comes up very often in estate administration because the executor is very limited in how they can deal with the business aspect. And, it's not to say that the executor can't deal with it, but there's no flexibility, or there isn't the flexibility or room to move that the deceased would have had when they were running the business. And we found that in these scenarios, especially with the family run business, it does tend to lead to a situation where emotions are running high. And more especially if the will isn't clear, heirs can feel that they're being left out of key decision making issues. And it can also get very messy. So that's the second red flag that I'd like to mention. Finally, Sarah, you know, the way in which technology is moving also has to mean that state administration and planning moves with the same speed. And we are finding more often now with the rise of digital assets that this can also add an added component of complexity to estates. So more often we are uncovering online accounts, online trading platforms, your cryptocurrencies, crypto wallets, and even unpaid streaming subscriptions like your Netflix and Spotify and things like that. Now, without clear instructions or details from the deceased in the planning stage, we do have that process now complicating because we may not be able to prepare a proper preliminary inventory because we don't know the value of these digital assets. And the executor might also need to get into an investigation to determine where these assets are, what the values are, and how to deal with the particular assets. So that can also add an added layer of stress.
Sorry, Melisha, you muted.
Sorry, did you?
No, just now, just now.
I
You
think
it's
I'm being
muted.
muted. But yes, just the issue of digital assets, Sarah, it's quite an important aspect to consider. And we need that to be included in the planning stages with those login details, with direction, so that we can access that information on administration.
Yeah, and I think that was going to be my follow-up question, Melisha, in terms of, I mean, you mentioned things like liquidity, family dynamics, and even digital assets, and just understanding those blind spots and how it complicates administration. So you've sort of touched on that. I don't know if you want to add on to that. If there's anything else that you want to add there, I know there are a lot of examples. You've just touched on the digital asset in terms of how that then complicates the administration process.
Yes,
Anything
Sarah,
else you want to add?
yeah, just to close on that, I just think that I would say why it becomes important in the context of this discussion is because we're looking at bridging the gap between planning and estate administration. What I've mentioned is what's now going to impede my process or pull me back in my administration. And what I would like is for planners to consider this as an opportunity when you are working with your clients to have these sort of discussions. Do not give a generic approach to your planning. Rather, look at the individual because I may not have a crypto wallet, but Mornay may be sitting with his cryptocurrency that needs to be now considered. So I would think that in the context of planning, let's look at our people on their merits as individuals.
Thanks for that, Melisha. And I mean, you've touched on it. So clearly there are challenges in the planning phase, which impact the estate administration. And the bridging of that gap is really critical to make sure that things work smoothly during the estate administration process. So in terms of bridging that gap, Morne, I just want to get to you just before we close. If you could give one piece of advice to financial planners drafting wills, but equally the client, because I think for me, something at this day and age where we have technology and we can ask questions, it's always critical. It's the same as going to a doctor, right? You do research before you see a doctor. You do research. What are the type of questions I should be asking when I do financial planning and all of that? But just a piece of advice, especially during the life stage of the client when they are planning and drafting their will, and the conversation between the financial planner and the individual or the customer. So what would it be, Morne, your piece of advice?
Sarah, yes. For me, it will be the question, what if?
Oops, I think we must have lost Morne. I think while we wait for him to join, Melisha, maybe I'll jump to you just to give us your. Oh, she's.
Yeah, sorry, Sarah, I'm not sure what happened there. Okay, so as I said, the question that I would ask is, what if? We're taking instructions, constantly ask, what if? The testator or testatrix also always assume that people will die in an expected sequence. But by asking what if, tries to cover the less unlikely situations. So when you sit there and you're drafting your will, you and your financial planner, ask the question, what if? I want to bequeath the house to my son. Now, what if your son passes away before you? What's going to happen to that house? Does it go to his son or his daughter, or does it fall back into the residue? What if you buy another property? So you just said, my fixed property to my son. But what if after the date of will, you buy another property? So make sure that ask these questions, what if, to eliminate any unexpected thing to happen after the date of the will, being the heir, the legatee, the residue heirs, the assets, so that we know as executor, when we have to deal with the estate, that all that has been covered when the will was planned and executed. Thank you, Sarah.
Great. Thank you so much, Morne, for that. Melisha, on your side, from an administration perspective or as an executor, what do you wish the planning discussion could be? What can they do differently to alleviate the issues that we see in estate administration, thus prolonging the winding up of an estate?
Yes, Sarah. As I mentioned earlier, I would love for our planners to deal with their clients on an individual basis. So when estate planning is being done, make sure that you ask the relevant questions. And for the person that's having their planning done, make sure you ask your advisor the relevant questions about what suits your scenario. And also put your planner in touch with key people in your life, your key family members, if you have an accountant, if you're running a business, your business manager, so that the planner can also deal with you in a holistic manner, so that every aspect is given due attention. And I would also recommend that there should be a closer collaboration between the advisors and your legal specialists, so that, as I said, a holistic approach is given rather than just a generic planning approach. I think, Sarah, ultimately, if we're looking at bridging the gap, we need to be thinking ahead of what's going to happen and making sure that the theory of planning is capable to be given effect to and that it works in practice.
Thank you so much, Melisha, for that. Yashvir, I see your camera is on. Do you want to perhaps on your side give us your closing comments?
Thanks, Sarah. Yeah, I think, when we deal with clients on a daily basis and when we talk about the estate planning, the answers that we get is that, yeah, I've thought about it, but I didn't just get down to it, or I just plain down, no, I don't have these plans in place. And, you're never too old, you're never too young, for an unexpected situation like that to happen. It happens at any point in time. Um, it's very important to have these conversations with your advisor. So if you don't have one, please get yourself a qualified financial advice expert to assist you with these issues in terms of estate planning. Let us assist you with the liquidity analysis. Let us show you the shortfalls. Let us show you the vehicles that we have in place to put in so that, should something happen, the estate is wound up smoothly, and it's who you want as the beneficiary of your estate for the assets that you've worked hard to attain, and also to take that stress of having to go through the estate planning process away from your family as well, and let the experts within the industry assist you there. Thank you, Sarah.
Great. Thank you so much, Yashvir. And I'm just going to wrap up now by asking Melisha and Mornay just to give us, your views in terms of how important is education and financial literacy in helping families avoid these pitfalls.
Yes, thank you, Sarah. From my side, my advice would be talk to each other. You as the husband, the wife, talk. Spouses should talk to each other. Get the children involved. Do not make decisions on your own. We're no longer in the 70s or 80s. We're currently now in this era where we don't have to keep it for ourselves. And then the information is freely available. There's the Master's website, SARS website. Get your tax practitioner involved. As has been mentioned by Yasvia and Melisha, get more people involved. Don't think you can draft your own will. Get your financial planner to assist or somebody with the expertise, and there shouldn't be any pitfalls. Thank you, Sarah.
Great. Thanks, Mornay. Melisha?
Yes, Sarah, as Marne said, education and financial literacy, it's really critical, and it will be the foundation of a client avoiding these pitfalls. As we've explained, that has been the thread of today's discussion. There's so many things that can go wrong, but with proper education, you can actually avoid these. And we're not asking families to become legal experts or tax expert or estate experts. But at the least, I would think that they should understand the basics, like what is a will, what a will actually does, why liquidity is important, and how debts are handled after death. So in my experience, I've found that it's the families that are the ones that are talking to each other, like Mornay said, the spouses that are talking to each other, the ones that have had the open conversations beforehand, that actually find themselves in the best position because they've made contact with the right professionals and they've done the background work to be able to be in a better position as opposed to someone who's going in having no clue of what needs to happen. So really, I would say empower yourself with this information, get the education that you need, and where you have questions, speak to the professionals who can help you navigate this process so that your loved ones are not in an unfortunate position on your passing.
Great. This for me was really insightful. I know I work in the industry, but every day listening to different scenarios, there's always new information to pick up. And I think today was more critical for me to understand that if you do your planning upfront, how does that then impact the administration process when one is deceased? And that's critical. But before maybe we close off, just to open the floor, I saw there was a lot of questions, some of which were answered on the chat. But Verity, I just want to give over to you to see if there's any questions that we can voice over.
Perfect. Thank you, Sarah. We've got quite a few questions here. I'm just going to combine the first two. Do beneficiaries need to cover the shortfall of an estate? And is there a shortfall cover one may take to cover the shortfall of the estate in advance?
Thank you, Verity. I'm going to open to our panelists, Melisha, Mornay, whoever that wants to take that. And I think with that question as well, I think for me, it shows upfront why it's critical that planning is done properly. So as an example, during your lifetime, when you do, and I remember when I sat with my financial planner, they said to me, Sarah, if you were to pass on now, are your assets exceeding your liabilities or vice versa? And at that time, my liabilities were more than my assets. And they said, Sarah, how we could mitigate this risk to avoid your child being in a situation where they now have to pay for a shortfall. I got a life policy, which I then seeded into my estate, and that policy then was able to cover all the debts and even leave some money to help. So upfront, the proactive planning is far much better instead of leaving your beneficiaries in a desperate state. But maybe just to give over to Melisha and Mornay, just to touch on, if now it's a situation, one is deceased and the beneficiaries are here and they need to pay a shortfall, what then? What options are there? Anyone can take that,
I'll
colleagues.
answer that question. Thank you, Sarah. If there's a shortfall in the estate, as I explained in one of my examples, you've got a fixed property worth, say, for example, 2 million rand. There's a bond outstanding of 300,000, and the cost of the estate in total, including the bond, you're looking at, say, 450,000. The brother and the sister inherits. Now, the will doesn't say that the property must be sold. There's no life policy to cover the shortfall. How are the heirs? Because I have to look at the assets. My assets is 2 point something million. My liabilities is 400,000 rand. How am I going to cover that liabilities from the estate side? I don't have the money. So therefore, now the heirs must pro rata pay that shortfall. Yes, there's an option. They can go and apply for a bond, as previously mentioned, or they can decide that the one will buy the other one out, or then at the end of the day, they can sell the property. Now, if at planning stage, the testator or testatrix knows that there's no money and they don't have policies to cover this, they can instruct for the executor in the will to sell the fixed property. They could also instruct how the property must be sold via an estate agent or auction. Therefore, we then don't need the requirement or permission from the heirs to say how it must be sold, or if it must be sold, we as the executor can then sell it. But we will always, as the executor, go back to the heirs and ask them, okay, we need to sell this property for auction. Are you okay with it? Shall we first try the estate agent? Because sometimes it's not always ideal to sell it per auction depending on the area. Some areas works nicely, some areas don't work that nicely with auctions. So it just depends, but we will always go back to the heir. Also, should a price be obtained, we will go back to the heirs regardless how it now was sold. The offer comes on the table, we will ask the heirs, are you happy with that 1 million offer or the 2 million offer with these conditions? We cannot sell then without their permission and without the master's permission for that accepting of that offer. So yes, in the end, if there's a shortfall, there's no policy that could cover the shortfall, then the heirs cannot come up with the money. We have no alternative but to sell an asset. Maybe we don't have to sell the house, but maybe there's a vehicle or two that we could sell. So there's those options to look for. But it's better at the planning stage to make provision for these shortfalls. Thank you.
Thanks, Mornay, for that. Verity, are we able to cover one more question?
Absolutely. I'm going to combine two questions from Louise Marais. Where are the monies held while administration is ongoing? For instance, where property is sold, does it go into the executor's account until distribution? And then how much is the inheritance tax in SA and when does that need to be paid?
I'll take this question, Sarah. So, when an estate is being administered, in terms of the Estate Administration Act, the executor must open an estate late account. So, all of the funds that are required to be collected from the deceased bank accounts, for example, or in the scenario of a sale, is placed into the estate late account until the executor is authorized to distribute. I just want to go a few steps back. If a property is being sold out of the estate, and the purchase price is paid, it's held with the conveyancers until that sale is registered. So when the sale is registered, it's then paid over to the estate late account. And that estate late account is administered by the executor who is in control of that account and will also have to disclose all of the transactions to the Master of the High Court and reconcile for the beneficiaries at the point of distribution. Now, on the point of inheritance tax is a UK dispensation. It's not called that here in South Africa. We actually have something called estate duty. So estate duty is payable in estates where the net value of the estate, that's the assets less the liabilities, that net amount is more than 3.5 million. And depending on the scenario of the estate, there may be certain rebates that can be applied. So an individual in their own right, it immediately has a rebate of 3.5 million from SARS. So say, for example, we determine that your net value of the estate is 4 million and you have a 3.5 million reduction and abatement from SARS. So then the net value is reduced for estate duty to the 4 minus the 3.5 million to 500,000. And estate duty is calculated at 20% of the 500,000 as the tax that's being payable to SARS. So as I'm explaining this to you, you will appreciate that it is dependent on the values of the estate, and there are certain considerations like the assets that are taken into account for the purposes of calculating estate duty that will all add to this calculation. So unfortunately, it's not a straightforward answer. But just on the point of tax, yes, there is estate duty that is payable to SARS on those types of estates. And there's also means to roll over the benefit, the abatement of the 3.5 million between spouses as well. So the executors can deal with that. If, for example, spouses that are married, the first dying passes away, then there's a method to move over the abatement to the second dying, second spouse rather. So on their death, their abatement increases. Yeah, it's quite complex, and I would suggest that a financial advisor is consulted there. Sarah?
Yeah, thanks, Verity.
Perfect. Next question is from Lindiwe. What happens where there are disagreements between the siblings in terms of who will be nominated as executor? Can the master resolve that dispute?
Yes, I will answer that one. When there's no executor nominated in terms of the will, or we're looking at an interstate estate where no will and the family approach the master to get somebody appointed. Now, normally one would look at surviving spouse and then children. They are excluded from providing bond of security. And say there's no surviving spouse involved, we've got now 3 siblings and one needs to be appointed. We don't have to appoint one. We can appoint all 3. The master can appoint all 3, no problem. It just creates more problems going further into the estate because the agent, depending on the value, you've got now 2 estates. You've got a estate below 250,000, which is administered in terms of Section 18.3, or any estate above 250,000 where a letter of executorship is issued. Thereby, the executor needs to comply with certain formalities in terms of the Administrations Act. You will have an agent representing you. So say that, for example, this estate is 1 million. The master is going to appoint all 3, for example, but he's going to ask who's your agent. So they will approach Absa Trust or they'll approach their attorney to be appointed as their agent. It just complicates matters. We prefer for one person to be appointed. But yes, if there's a dispute, the master will make the final decision because he has to look at who has an interest in that estate. If it is the uncle that wants to be appointed, but their siblings, the uncle won't get appointed. The siblings will be appointed unless they are disqualified to be appointed in terms of certain law requirements. I hope that answered the question. Thank you.
Thank you, Marne.
Okay, I think we have time for one more question from Sylvia Ackerman. What is the procedure with a joint bond and the other is the beneficiary, the deceased having cars, etc. in their name? Will funds be released to assist the beneficiary if they don't have funds?
Yes, so with regards to the joint bond, the bond does need to be settled or taken over. So the surviving spouse in the scenario would need to make application for the takeover of the bond, and the financial institution would need to determine if she qualifies or he or she qualifies, depending on their credit worthiness. So there again, that is not something that the executor can dictate. It will depend on the situation of the financial viability for that spouse. With regards to releasing funds, funds can be released, but it will also depend on whether there are funds that can be released. So we need to look at the estate holistically, and we would not be able to release funds where there are multiple creditors, for example, secured creditors. They would have to be seen to first. So we would need to look at the request for the advance in the context of the estate to determine, is this something that we can allow, or if not, then we'd have to advise the client accordingly. Sarah?
Thanks, Melisha. Verity, I think we've come to the end. I'll just give over to you. Thank you so much.
I think the audience will agree that the panel has been absolutely amazing. Thank you to you all for taking the time to share your wisdom and insights with us. There will be a second installment in the series, which we will be posting on our LinkedIn pages, and we will be emailing. So please do look out for that, and please do register. Thank you to you all for attending, and wishing you a wonderful day ahead. Thank you.
Great. Thank you. Thanks, everyone.
Thank you. Bye.
Bye-bye.
Thank you.
Bye.
Lovely
Thank you. Bye.
session. Thank you.
Thank you. Bye.
Bye.
Thank you. Bye.
Thank you. Bye bye.